For more on the implications of lower crude prices for India's economy, I'm in conversation with Dhiraj Nim, economist at ANZ Research. Dhiraj, thank you so much for taking time out for us today.
Thank you, Pallavi.
So, to begin with, just help us understand what are you making of the current scenario. Despite continuing fears on the geopolitical front, we have seen almost a consistent decline in crude oil prices over the last few months, and that does seem to indicate some upside for the Indian economy.
Well, look, to be honest, I think the House view is that this is on the back of recession fears and could have an element of market positioning behind the oil prices falling so drastically. Now, which means that if those expectations are not materialized, there could be a bit of an upside to oil prices from here. But there is no doubt, of course, they're weaker from where we were at the start of the fiscal year. In net terms, of course, oil prices declining is a positive development or a good news for the Indian economy, which is a net oil importer, of course. But we have to be mindful that this correction is on the back of a pessimistic demand outlook for the global economy. And that by itself does not mean very well for any economy, let alone India.
Okay, all right. So, given the fact that it comes with possibly lower export demand as well over the next few months, what are you currently making of these macro indicators? What are your projections in terms of the current account deficit? And what's the expectation going forward, given that we are seeing slightly lower oil prices on an average, but like you said, fears of a recession in the US, and we're already seeing slowdown that we've been seeing for some time in European markets. What does that mean for current account deficit at large?
Right. So I think three factors to consider there. The first is that we expect India's growth to remain stronger than the rest of the world. So in volume terms, the net trade could continue to favor a wider current account deficit. We are projecting it at 1.5% of GDP for FY25. The second bit is about currency. Look, the rupee, we think, is slightly undervalued on its own, but still is not, very competitive against all of the currencies in the region, especially the yuan. So we think that that may continue to play not so very much in favor of India's current account. And the third bit, as you're saying, if the oil prices do sustain at these currently depressed levels, well, that would be a bit of a positive terms of trade shock, which could actually improve the current account balance. So I think all of these considerations combined, and if we don't end up in a scenario where global demand is literally falling off the cliff, I think India can continue to have a current account deficit which is eminently, financeable. So something between 1 to 1.5% of GDP could very well be where the current account deficit lands in FY25.
Okay, all right. And in terms of inflation, while data for US inflation is expected later today, we are also expecting data for India's inflation, the print for August that's due tomorrow. Now, we're already looking at low inflation. It is expected to come in within the RBI's band and actually below the 4% target. Given that setup, given that we're already seeing some sequential easing on vegetable prices. At the moment, we're also seeing Kharif sowing being completed or near completion. On inflation, what's the outlook? And added to that, what's the likely impact going forward from the lower crude oil prices?
So let me answer your second question first. If crude oil prices do remain low, that means, the Reserve Bank of India, as would everybody else, will have to lower the inflation forecasts for FY25. Now, we all know the usual sensitivities. If oil prices are 10% lower, inflation could be lower by about 30 to 40 basis points. That's the usual understanding or the rule of thumb we have in India. But speaking of inflation tomorrow, I think it's not so important that inflation is less than 4% target. We know it is largely because of base effects. But I think what's important is that inflation is tracking well below the Reserve Bank of India's forecast for the quarter, in the sense that for Q3, the Reserve Bank of India had predicted a 4.4% inflation average, and currently it's tracking way below that. So there could be a substantial undershooting on inflation, which could mean that the Reserve Bank of India may tone down their hawkishness as far as inflation is concerned, and may even warm up to rate cuts perhaps by the end of the calendar year. Now, the news flow on front of agriculture, in the sense Kharif crops showing trends, etc., has been quite encouraging. But I'm tracking the daily price data. While I do see substantial deceleration in the prices of key vegetables, the potatoes, onions, and tomatoes, but I don't think a lot of it is still seeping through other vegetables. So I think there is still more time for that Kharif crop to arrive in the market and actually reflect in lower vegetable prices, which should substantially ease food inflation concerns. But I think we're still some time away from that.
Okay, all right. Added to that, I do want to ask you now, typically there is a rule of thumb we tend to follow that, when, say, maybe there's a $10 per barrel increase or decrease in crude oil prices, we typically tend to see an impact, a direct and indirect impact combined of almost about 50 odd basis points on inflation. Given the current scenario and assuming that we continue to see crude prices remain at current levels or slightly lower, do you have any thumb rule estimates that you can provide at the moment?
Look, I think the rule you mentioned is very much what we follow from the Reserve Bank of India, is generally the consensus. But I do want to highlight a caveat there. Look, a lot also depends on how much of that lower oil price is being passed through to consumer prices. And I think that's where, the contention lies. If the actual final price of the fuel for the consumer does not come down materially, it will have a limited impact on consumer price inflation in the direct sense. In the indirect sense, if the wholesale prices for fuel do come down for producers, they may want to pass on, some of that reduction in input costs to consumers. But mind you, it's not looking that favorable a scenario, in the sense that private consumption recovery has happened, as we saw in the last GDP print. And at the same time, we are seeing signs of profitability stress in the corporate sector, which could mean that there would be a bit of an output price rigidity to maintain profit margins if input prices do go down. So while across the cycle, there may be a bit of a rule about 50 basis points of decline in headline inflation for, say, a $10 per barrel decline in oil prices, I think it could be lower this time, given the kind of macroeconomic configuration we have, but certainly a downside risk to the 4.5, inflation forecast for FY25.
All right, before we can let you go, a very quick question on the growth implications as well. So like you said, this time around, we are seeing a slightly mixed set of high-frequency indicators as well. We're already seeing some easing on some of them. But there again, lower crude oil prices do look like they can provide some comfort, given that the fears regarding the US recession don't materialize to the extent that, one might be sort of anticipating at this point.
Sure. So I think even if, the US recession fears don't materialize, oil prices still could be lower than they were, let's say, at the start of the fiscal year, which would possibly mean, they sort of incrementally support an already strong growth momentum in the economy. Well, as you said, again, another thumb rule is that a 10% lower oil price could mean, 30 bips higher GDP growth, everything else unchanged. But then the key point is that is everything else unchanged? So we'll have to watch out for that. I do want to highlight one important point here, though. In India's case, a positive terms of trade shock usually tends to appreciate the currency on real effective basis. And given the kind of competitive currency scenario we are currently in, that may not bode very well for India's exports and therefore India's growth. So I think, some kind of policy intervention may be necessary if oil prices do remain very low, and there is generally a positive terms of trade shock, which could appreciate the rupee on the real effective basis.